Welcome to today's conversation. I'm Daniel Shvartsman from Investing.com. Today I'm joined by Jamie Rogozinski, the founder of WallStreetBets. Jamie, good morning. How are you doing?
Good. Thank you very much for having me, Daniel.
Yeah, it's great to have you. So we're going to be talking, you're giving a free presentation for XTB on how to build your 2022 portfolio WallStreetBets style, and we'll get into that for sure. But I'm just curious so we're recording this on March 9th. We'll be publishing it this week. We're basically 2 years from the pandemic, like when it really became a worldwide phenomenon. We're a little over a year from the meme stock's first big boom, which was associated with Wall Street bets, at least to quite a degree. What do you think about the market right now? What do you think about what's happening? What do you think about where we are? State of obviously there's Russia, Ukraine, there's inflation, there's a lot of things going on. What's your sort of sense of things right now?
Look, for the past, I would say 12 or 14 years, we've had nothing but this bull market, this nice, unvolatile, meaning like short candles, not huge price swings. Stocks only go up, et cetera, right? And so throughout these 12 to 14 years, you always have these potential catalysts and everyone going, dollar's going to go down because they're printing, or China's going to default because of Evergrande, or, we're going to go to war with Ukraine. Because remember, now we're on our second round of this, right? Arguably, this is different, but all these potential alarms throughout the years, all of which have been potentially legitimate, well, most of them turned out to not. Even during the pandemic, when the market did have some volatility and it did see some crazy things happen, it wiped about half the price off the equities. You saw things like oil going negative, right? Something we can all probably wish we could have taken advantage of, but even that bounced right back, right? And that was a genuine shock to the entire supply chain. I mean, there was fundamental reasons for that. But this right now, what we're starting to see right now is what the eventuality of the markets are going to bring, which is cycles. You have cycles of booms and busts. You have bull markets and bear markets. And throughout these 14 years, it's always like, this is it, this is it, this is it, this is it. And any time that you would have tried to short the market or whatever, most of those times you'd have been in trouble. This particular time, I'm hesitant to say this is it, right? But this has a lot of things to really make it sound like we're going to see some volatility. I'm not going to call it a bear market or a crash of everything or the global economy or the U.S. dollars. That's not the way that I approach these things. But what I can say is this is going to shake things up. This is clear that we're going to see a lot of repricing taking place, a lot of restructuring of the way that the commerce and global economy is working, and we're at the very early stages of it. So I think that we're certainly in for a different market environment than what we've seen since probably the 2008 financial crisis.
Well, it's interesting because what was so interesting about the last shock, the pandemic, was that a lot of the stocks that did well during the pandemic were the stocks that were already the winners. And so it really reinforced that by the dip mentality, whereas this time there may be more of a shift. How do you, I know you're not associated with now, but having founded Wall Street Bets, how do you sort of, like, what do you think about the impact of that community and the surge of the retail investor more generally on all of this? And how do you think they're looking at this, given that this is the biggest shock since sort of the start of the pandemic? Like, how do you think the newer investor is managing all of this?
Well, what you see with the Wall Street Bets subreddit, which is a community, it's a window, it's an avenue for people to get started or exposed to stocks. What we've seen what happened with Wall Street Bets as a whole is kind of superseded that one particular forum, which in and of itself isn't even all that welcoming to retail traders. A lot of people that want to learn go to the actual subreddit and then get lost pretty quickly. In that the topics are slightly more advanced, and then they're masqueraded by its own nomenclature, which is difficult to decipher. But you've seen a lot of people say, well, fine, we're going to be Wall Street Bets for crypto, and we're going to do this on Discord and Telegram. And there's a lot of social media channels where this is at, and Wall Street Bets has become this kind of a symbol, this omnipresent philosophy of empowerment of the retail, the accessibility of financial instruments and markets, the empowerment to be able to take control, right? And in the case of what we saw last year with, last year with GameStop, is we're actually going to have an active participation in the market. We're actually going to have a voice and actually affect the functioning and the prices of the market itself, right? So what we're seeing, what we've seen since even before GameStop, since I did create Wall Street Bets up until now, is this ever expanding philosophy. We're saying, I can actually do this myself. Maybe I'm not going to do these out of the money, short expiration for short days till expiration stock options, which are pretty obscure in and of themselves. But maybe I'm going to buy an NFT or one of these crypto coins or a stock or a thing, because now the sophistication of the veil of sophistication behind a lot of these markets and instruments has been lifted, and it's a lot more inviting. Say, hey, go ahead and experiment. You could maybe make some money, maybe you won't, maybe you'll stay the same, but you'll learn. And that's really cool to see. And it's cool because it's everywhere. Wall Street Bets sounds like it's Wall Street and New York, or New York Stock Exchange, NASDAQ, and all these things. But it's ever, I had an email a couple months ago from Korea saying, hey, can we start Wall Street Bets? There's K Street Bets here, in India Street Bets, and you have Silver Street Bets and Satoshi Street Bets, and you have so many street bets that are either specified or themed around a particular instrument or a particular country or a particular philosophy. And that's super cool. And that's what's really transcended from just that one forum.
Yeah, that's something where that international perspective is something we're lucky to see too. And I remember at the year end, we published a bunch of articles reading about like the Dongkak ant revolution in Korea, which is like the investor revolution tied back to some historical event in Korea. But yeah, it's fascinating. But I wanted to, one thing you said something interesting there about, maybe they're not shorting out of the money options or whatever. And I think you talked about the nomenclature. And Wall Street Bets, bets is in the title. And I think for a professional investor, one can think about, oh yeah, everything's a bet. There's a probability or whatever. But I think generally we think of that as more gambling than investing. And Wall Street Bets, I think, has the reputation for, YOLO, you only live once sort of trades. And maybe this is unfair, and you can correct me, but it's sort of a riskier approach. And I wonder how you think about that with the newer investor. Like like the newer investor may be better off just indexing and then maybe dipping their toes. So how, like your perspective as somebody who's kind of seen this evolve, how do you take that?
Well, look, I get asked all the time, well, what do you think people should invest in? I'm like, well, indexes, right? That's my personal long-term portfolios and indexes, right? Like it's very known. I'll save you a lot of reading by just saying that, right? But you're right in that Wall Street Bets there's two kind of implications to that. The first one is, yes, we're speculating. We don't know the outcome. We're the probability, right? This is something that even Warren Buffett does, and sometimes gets wrong. He gets it right much more often than wrong, which is why he's so successful, but he still speculates. And, the airlines cost him dearly during the pandemic because he couldn't have guessed, much like the rest of the world, that kind of thing would happen. So there is that element of speculation involved, of uncertainty. And that's where the money gets derived from, which is the second part of the word bets, which is risk and return are the exact same thing, right? Like mathematically speaking, there are no difference. If you want to try and make more money, you have to risk more money. If you want to try and make 100% profits, if you're in a casino playing roulette, right, you can put everything you have on black or on red or whatever. And then you will either lose 100% or actually make 100%, right? That's a one-to-one thing. You can then bet on the inside of the roulette table and make 35 to 1, but you're 35 times more likely to lose. And so, or slightly more, I guess. But the idea of saying we're speculating, one, and number two, we're going to speculate on the stuff that is got higher propensity for making money or getting rich quickly. Right. And the implication of getting rich quickly is that you'll get poor quickly as well. And I'm being unfair because I think that there's ways to mitigate becoming poor while taking a lot of risk in the market, mainly, limiting your exposure. So that comes from that philosophy of saying, okay, well, I am a millennial. And myself, when I started WallStreetBets, was in this position of having lost my job because of the financial crisis, having gone through kind of a tough stretch and ending up in a very comfortable job, but not so comfortable that I'd forgotten that hardship that I'd gone through. So it's like, let's try and figure out how to use some of the extra money I'm making to get rich quick. And then I don't have to deal with this again if something like this happens, right? And so I'm not going to get there by investing these diversified 5%, dividend paying stuff. Like, yes, it's safe. Yes, it grows. Yes, it compounds. Yes, if I had 30 years and $1 million to start out with, I'd be all right. But if I have nothing to start out with and I can start putting in just $100 a month or whatever it might be, I don't have that kind of patience because maybe 10 years from now, we're going to have some, big global conflict. And now we're back to where I started and I only have a couple $1,000s in the savings because we didn't get the compound. So let's try and risk more. And that's what it comes down to. And it's frowned upon a lot by traditional investors because they're saying this is risky. You're going to lose. This is indexing is the way to go. And it is if your goal is to retire in 30 years and you are able to produce enough money to generate that. WallStreetBets is another way out in which a lot of people lose money, but a lot of people also made a ton. And I've seen this time and time again, take $1,000 bet and turn it into $100,000, right? Or millions of dollars. And that's the embracing that aspect of it, specifically targeted to these younger generations that can, they're more able to take that risk and they're hungrier. They're more predisposed to try and empower themselves financially so that they don't have to depend on factors that are outside of their control.
It's so I just want to back out to something where you sort of gave the casino example as like risk and return should be aligned. I mean, I guess the whole game is to find where it's not aligned and where you can have an advantage for whatever reason. And that's whether or not that's out there. Do you think that so I guess the two things, and I'll use the casino example. On the one hand, do you think that it seems like it's a community, and again, you're not maybe immersed in it per se now, but like it seems like a community that is aware of these risks, but I'm still just thinking at the risk of being a traditional old person, like of the retail investor joining, like, do you think that the risks are clear enough? And also the issue with the casino is that you pay the VIG, right? You pay you just said it's a little bit worse than 35 to 1. There's a transactional fee. And that's also like in the wash, that's going to, so I guess I'm still just, I understand that. I want to ask about the sort of anger or the frustration that you got at, but before we get there, like, do you think that there's, how do you look at that, those factors?
Yeah, I mean, if where you're going at is the house is always wins, right? The casino is not winning and losing proportionally to your winning and losing, right? They do stack the odds in their favor slightly. Yes, that is the case on Wall Street as well. And the other implication, I believe, in your question was, is it just random chance, right? Is it just randomly guessing a number, or is there a method to the madness in which somebody has a higher likelihood of getting it right than getting it wrong? And my answer is yes, of course. And it's proven, given the fact that some people can consistently and persistently perform the market in general or under individuals with a very provable, statistically significant manner that says, okay, that guy is more than just lucky. That guy has skill, right? And so there is that competitive advantage, that asymmetry of risk that's been identified, and that inefficiency that's being exploited. And that's the key word here, right? There are cases under which somebody that puts in the work, like Warren Buffett, that evaluates the companies probably with a pen and paper, right, and multiplies these things, reads the statements, and then comes up with a number, and then looks at what the market is pricing this thing at and says these things don't match up. According to my thing, it's worth more than according to what they're pricing it at, and therefore that inefficiency is one that I'm going to bridge, right? That's like a very traditional form of arbitrage, which is what it comes down to. So that inefficiency of saying, okay, well, I'd like to guess, but I also want to guess in such a way that I'm more likely to be right. I don't literally just want to flip a coin. Where can I try and do these things? And that's where you see WallStreetBets taking a different approach of things, saying, well, we can't compete with high frequency computers. We can't compete with, which have their own competitive advantage and inefficiencies that exploit. We cannot compete with Goldman Sachs or these investment banks, the tremendous number of analysts and experience and even exposure or know-how, all these different factors. So let's keep looking for stuff, and let's flip coins. Sometimes we think this earnings report's going to be good because whatever, make some memes, that works too. But let's not forget that Roaring Kitty, aka Deep Effing Value, Keith Gill, the GameStop individual, his was never a YOLO, although it was insanely high risk, right? He had a lot of conviction behind his theory, and he could have ended up being wrong, right? But he turns out that he was right. And then it turns out that he was helped a lot by this retail pile-on effect that was had, but that came from what he identified as a competitive advantage or an inefficiency he was looking to exploit. You're able to do that too while taking risk, right? It's that, hey, where do I stand? When you go to a financial advisor, the first thing they ask you is the most terrible question. So the most boring question you want to hear, well, what are your goals? What can you afford to risk? And when do you want to retire? And how much do you want to, and those questions are annoying because I want to retire today with $1 bazillion, right? So make that happen. Oh, and I don't want to be able to risk any of my money. Right? The advisor is going to say, well, we can't do that. Literally, there's levers. It says, what's your time horizon? How much you can afford to lose? How much you can afford to put into it? Blah, blah, blah. And then that's going to spit out this mathematical answer, right? That same methodology is being used with WallStreetBets that are saying, look, I do want all that stuff, but for the time being, and I'll get to that later, but for the time being, I have maybe 6 months of this craziness to try and get to risk a little bit of money to try and make a lot of money, and let's hope I get it right. And if I don't, then I lose all my money. Then that sucks. But then I'll just go to work and I'll get my paycheck again, and then I'll just do it the other way. Right? I will have tried this. But then you have the select few, which is not the majority, but you do have some people that do actually make a ton of money. Say, good, I was able to achieve what I wanted to. And the people that took that risk and lost their money, it's not like they lost their mortgage their house so that they can try and do this YOLO bet. They most likely were trying to get a mortgage or a down payment. Like they probably weren't unable to afford that. So they just lost their disposable income for that particular period.
Well, and I think the community aspect is so interesting about it because there is sort of a sharing and a feeling of, again, from an observer's level of sharing in one another's success and also having fun with, for better or worse, with the failures. And so I think that may be part of
the communities. It's an interesting thing because that's kind of where we're living at now. There's a lot of community social media. You're learning from each other and you're cheering each other on, or maybe like licking your wounds with them or whatever it might be. That there's a strong element there, and there's that feel good element. Let's socialize, let's hang out, let's talk, let's joke. And that by itself gives people a source of pleasure, of happiness, whatever. So as an entertainment component, that's already paying off for a lot of people. But then there's also like a sharing of knowledge, which is the second layer of that, which is, hey, what do you guys think of this? And then you have this kind of a visibility system. If you're on Reddit, it's through upvoting or whatever. If you're on Twitter, it's through retweeting and liking. Or if you're every platform has their ability to push certain voices, ideas up and give them more visibility. So if you came up with a good idea, you're more likely to be heard, right? And criticized for people poking holes in it. So you're crowdsourcing the thesis behind your trade. And then the third layer on top of that, which we're witnessing, is now you're actually able to affect the market, which is, well, I think that GameStop is going to go up, and then everybody buys GameStop. And then obviously I'm grossly simplifying it, but then GameStop goes up in large part because of so many people wanting to make the price of GameStop go up. So there are multiple layers to this community, which I think is relatively new. People point to Yahoo message boards in the 90s. Sure, it had similarities, but it's not the same thing in that now you have full-blown communities that very much affect each other and in the real world in ways that we didn't have back then.
For sure, yeah. I mean, it's having worked in the financial media with sort of crowdsourced or semi-crowdsourced platforms. I think what Reddit does is, or WallStreetBets is, seems like it's a little more horizontal. There's less of a, and so there's maybe more noise, but also more room for things to sift to the top without having to go through anybody. What do you think about, so one last question before we go to the markets and your 2022 portfolio presentation. You mentioned your frustration in the economic financial crisis and the long recovery. Anger was an element, I think, and it's still, there was a New York Times piece with AMC holders, and there's this sort of anti-Wall Street, anti-hedge fund, beat them at their own game sort of thing. And I guess you made the point that the market has, until, there are bumps along the way, but it's mostly up and to the right if you zoom out. And short sellers really got the brunt of the heat, even though they've also gotten the brunt of that up and to the right, and their heads getting handed to them because it's a tough market to short in. So I'm just curious what's your take on that sort of frustration or anger among this? Do you think it's still out there among the retail investors? Do you think enough of them have gotten their hands on the wheel that it's less of a concern and now it's really more about the bottom line? Or is that still a part of the picture?
I mean, I think that the seeds of this picture, I think the foundation on which this picture was created started with those feelings. You have this group of this demographic of people that are affected and are angry or frustrated or whatever, fill in the blank with the emotion, and then go out there and they pick it and they're setting their camping tents outside of Wall Street and occupying it. And, frustrations are being expressed in that manner, right? So a lot of those feelings didn't go away, and you saw a lot of it resurface last year with GameStop. You saw a lot of comparisons or references to the Occupy Wall Street movement. This is well over 10 years afterwards, because people haven't forgotten that. But since that moment, there's been a lot of people. Look, 2008, you had a lot of 20-year-olds today that were 8-year-olds then or 6-year-olds then, so they don't have that same frustrated. They didn't live through that necessarily, but now they're actually in the demographic of trading and investing, and so they're just picking up where the people that were affected left off, which was, hey, we're upset, we're doing this for ourselves. And then you have the younger people like, well, I don't know what you're talking about, I never lived through that. But sure, I like the idea of empowering ourselves, and I like the idea of taking control. So let's just go with that. So you have this kind of inherited mindset, whether or not you have that experience or those feelings that you've pent up, but it lives through that same philosophy. That I don't think has changed. And then you have, the markets that have been going up. I think the philosophy there isn't so much, hedge funds are bad because they short. That's kind of a weird, it's a weird perspective. I don't necessarily understand fully, but if they're upset that the market's going up, I also don't understand that, because people have taken the approach of, if you can't beat them, join them. And we could complain about it's because the Fed is printing money and the dollar is going to go down and inflation and this age-old arguments that have been around forever. people are like, why are you talking about the Fed when you can just buy stocks? They only go up, right? And then people, you don't understand, you unsophisticated buffoon. But they do only go up. Oh, but you weren't around during the 2008. And like, I wasn't around during the Great Depression either. But if you zoom out enough, you can see that the stocks have gone up since before the Great Depression till today. But they went down. Yeah, but then they went back up. So get back, 1987 to 2000. Like there's a lot of these, even the 2020 crash, which didn't even last enough for it to be remembered anymore by most people's standards. Like that idea of saying, well, we're going to go ahead and make money while you complain about stuff because this works out in our favor. And I have no doubt that if the markets go down, that the people on Wall Street bets are going to short the market. And I know this because they did that during the 2020 crash. And they made so much money that they felt guilty that they were cheering on the destruction of the world, that they ended up donating a lot of their profits because stocks go down faster than they go up. And so their profits were immensely quick. And so then I was personally a drive of one of these charity events. So they're in it to try and make money. They don't care the direction. They're not investing long-term dividend, whatever. They are taking these short-term speculative trades in which they say, let's make some money and just tell me whether the stock's going to go up or down. And I will push the appropriate color-coded arrow button on my mobile phone's broker so that I can bet whether this thing goes up green or down red, and then I'll make money, hopefully.
Yeah, there are a lot of things that you've kind of dropped that will be fascinating to jump into, whether it's, you mentioned earlier, Keith Gill and the GameStop thesis, or just now basically a rebuttal to perma-bears over the last decade plus, and also even just the ease of mobile apps. But we probably don't have the time to go into each of those directions. So I just wanted to leave them there as maybe a next time. But
yeah.
So let's jump. You sort of said markets you started at the beginning saying this time, there's some uncertainty around there. At the same time, on a long-term perspective, the U.S. stock markets do tend to go up. Even if you have prolonged bear markets, they, again, over time, you're going to give your 2022 portfolio. I don't know if you're giving tell us a little bit about this XTB event, what you're planning to do there, and and how you're thinking about the market.
So I'll tell you a little bit about XTB, and then you can re-ask that question so that I don't forget it. What I'm doing with XTB is actually slightly different. I'm not going to tell people necessarily how to create their 2022 portfolio because I don't do that. Not for myself. My 2022 portfolio is invest in an index and keep it in there, right? And that's going to be my same one for 23, 4, 5 until whenever I need to pull my money out of the market. So, and I'm not ruining anything. That I'm just going off of wisdom that is known by anybody and everybody that knows anything. But what I am going to do is break down how I approach the market in this new retail environment, right? What can I do in 2022 to give me a competitive advantage, to spot inefficiencies with which you have a higher probability of making money than you are to lose money, which is, I can carefully worded the way I say higher probability of losing money, because there's a lot of more factors than just getting something right or wrong, or how many times you get something right or wrong. But it's that approach: is you have a lot of volatility, you have things that are moving up a lot and down a lot, and you have a lot of forces that are affecting the market right now that are different than what they were last year, or in 2020, or in 2019. Those 3 years have been very radically different as far as financial markets are concerned. And this year it appears to be presenting its own very unique factors. So so I'm really looking forward to sharing my thoughts and my approach with how to deal with it's no longer probable turbulence. It is turbulence that's pretty much already been written. It's, when I say that this time it's probably different, it's because of some of the changes that we've already seen be created are going to be, if they were to roll back, they would be very time consuming. So no matter what, the changes that have gotten into effect over the past week and a half will not be undone anytime soon. And that by itself is guaranteeing some different market forces. So what am I looking at? How do I think it's affecting it? How to be able to approach turbulent waters, because turbulent waters are insanely difficult relative to calm, steady, up and to the right type markets.
So it's, we investors talk a lot growth versus value. We're entering a value period. It sounds to me like you're the Jamie Rogozinski or Wall Street Bets mindset is adaptable to, it's just sort of different pieces on the playing field is how you're thinking about it, but it's not necessarily a grand shift in terms of philosophy. Or how would you describe it?
Yeah, there's things there's a common denominator which will apply to every single environment and or trading style, right? I will, in my own crazy way, agree with Warren Buffett and the high frequency traders and the technical analyst traders and the meme stock traders, right? There is something that actually applies to them, these fundamental approaches to how you're defining inefficiencies, profit opportunities in the way that you're measuring and assigning a potential money-making opportunity to them. That stuff, the math behind that, which doesn't have to be really complicated math, it's a very simple approach. It is the same equation to everybody involved. The difference that I'm taking into consideration is, all right, now that I understand the fundamental way in which I quantify the likelihood that I make money, now I'm going to say which factors are going to matter this particular year, right? If last year, I know that there was a lot of emphasis on meme stocks. So a lot of the questions I get is, what's the next one? And you have a lot of services that went out there and said, we're going to read a market sentiment based off of what the next meme stock is going to be. The theory there was there's going to be a lot of these stocks that people are going to pile into and drive the price up to exponential levels. And that's kind of a new technique. And so in order to do that, we need to pay attention to these things: chatter, sentiment, whatever, upvotes, retweets, right? And that's the thing that matters this year. Whereas the previous year, with coronavirus, who knows what those might have been. This year, I believe there's going to be different factors. We still have meme stocks. We saw it Bed Bath and Beyond earlier this week do some crazy things. So clearly that hasn't gone away. Ryan Cohen continues to exert this crazy influence over stuff. It's just maybe not as frequent as people were hoping that it would happen, or maybe not as strong as they would. Who knows? But there are some other stuff which I believe is going to be the stuff to look at, right? Which is going to deal with this shifting landscape in fundamental value of which direction the money flows and how it flows. A very simple, digestible example is oil, which I referenced earlier. A couple of years ago, it was negative prices because people didn't know where to put it. And, these were futures that we're talking about. And so there was this logistics issue involved with that. And that's the reason why the prices went so low or negative. It was a mechanics thing. And right now, it's a much easier to understand version of it, which is the prices are going up simply because the supply is going down, or the threat of the supply is going down. And even that's complicated. But that in itself was its own safe bet. Previously, I might have told you don't pay attention to oil. This year, I might have said, well, maybe pay attention to oil, right? That's a silly example, but it's an obvious one. There are other ones that are less obvious that I think aren't being talked about enough because they're slightly more obscure, and the deal was just supply chain and the commodities, the global interactions, the actual logistics involved with doing stuff.
Yeah, it's like you said, there's a lot of factors right now, a lot of things to balance with inflation, with changing Fed or central bank behavior and so on. Do you want to get into any of those obscure ones, or you want to save that for the event for now?
I can get into whatever those might be. It might sound like a lot of times that I'm talking about things that are highly academic, or this doesn't sound Wall Street bettish. There's a lot of Wall Street bettish stuff on top of that, right? So just yesterday, for example, there was this approach where, they can't beat them, join them mentality of stocks going up, you should go ahead and buy them, right? There is this attention that's brought to the fact that members of the US Congress are really good, exceptional traders. But by good, I mean like they have had some very successful portfolios, if we want to call them that. There's a lot of speculation as to how and why and fair or not fair. I don't really care to get into that. It's not, it's not my area of expertise, but I do see that they're getting extremely good returns. And so can't beat them, join them approach says to me, I don't know how, but I know that there's obviously some advantage there. Let's copy them. So we released this new it's called Exchange Traded Portfolio, which acts like an ETF, which is available around the world. People could buy this thing, and then it literally mimics Nancy Pelosi. Whatever she does and discloses, this ETF is going to replicate to the best of its ability based off of what's disclosed and when it's disclosed. And so that's the approach. It's like, wow, she's actually really talented, or she just seems to be really good at investing, and she's a great stock picker. So let's go ahead and make money. If she's making money, then let's go ahead and make money too, or at least try and get a little piece of that. That's the approach of when I'm talking about finding these competitive advantages, right? I don't know, but I don't need to know why she's as good as she is. I know that I'm able to try and make some money if she's able to make money. So let's go ahead and do that. What are the factors that we're going to be considering this year? I don't know that they're fully set in stone yet. I'm currently like on this vacation. I'm in Madrid right now and trying to enjoy. This is supposed to be like the post-COVID whatever. So I have not had a chance to internalize fully the mechanics of what's happening. Obviously, I'm very well informed as to the events, but I have not taken the time to study. I know that there's going to be inefficiencies that are put about based off of the fact that logistics in the world are very different, right? We know that Russia is being closed out either because of sanctions or themselves. They're kicking people out. So airplanes can't fly over to or from, ships can't go to or from, packages can't go to or from, right? Commodities, which are unbalanced, are going to get thrown out of whack. That vertical supply chain of what happens to these commodities, there's going to be some hidden gems in there. There's going to be some obscure company who fully relies on a thing that's created by nickel mixed with wheat, who knows, right? Like, and then you have this one thing put together and all of a sudden nobody realizes but this company is the one that's going to crash. And or this sector, right? Like is going to get affected in this way that's just as obvious as the oil trade, but a lot less sexy for, the front page of the Wall Street Journal. So that's the kind of stuff that I'll be looking at. Same goes with the implications, the Forex, right? We're seeing a lot of movements in the Forex market. That trickles down to businesses, that trickles down to actual stocks themselves and indices. We're also seeing a decoupling of indices, which is kind of fun to watch, right? Like it's always been when I open up the markets in the morning, I say, well, what are the stocks doing, right? And I literally just look at like, the U.S. loves the Dow Jones for some reason, but but even still, that's good enough because Dow Jones, S&P, and NASDAQ, they go in lockstep, right? And you can say, no, they don't. One went down 10% more than the other one. Like, yeah, but the shape kind of looks the same, right? They both go up, they both go down. Very rarely, but it happens. You'll see them all do something slightly different, but they're all very highly correlated. When you zoom out and look at the DAX, or you look at the Euro, the Euro X50, or you look at the Nikkei. They're all doing very similar stuff, up or down. And now we're not quite seeing that. We have, yes, but to a much less degree. That decoupling is exciting for traders. And it should be for the economists of the world too, because that's implying more robustness and having fewer systemic risks, more diversification opportunities. Like there's a lot of things there. But on the other hand, it also means, okay, stocks go up here, but not there. You can now say that, right? That's kind of cool because that gives you more choices. So we'll see how and why that's happening and go off of that.
Okay. That's a pretty thorough overlook for now. One last question for you that I'm thinking about with all of this is a lot of people will look at this market compared to the dot-com boom, right? Retail investor surge, lots of weird things, big excitement, a lot of tech excitement, etc. And I'm asking from a self-interest perspective, but I suspect it's one that's of interest to you too. Like, do you think the retail investor, they've hit some Zoom is, which we're recording on, is down whatever 70+% from its highs. Like, do you think the retail investor is gonna, or the Wall Street Bets investor is here to stay? Do you think they're just the newer investor that's come on in the last 2 years? Do you think this craziness is gonna scare them off, or do you think they're sticking around?
No, they're not going to get scared away. They're sticking around in that they now know what this thing is, right? You're not, before, if you went to someone and say, hey, do you want to do the stock market? You might be talking about these annuities and fixed income, what, like just jargon. It's like just either boring or overwhelming or not, doesn't apply to me type stuff, right? Like, what are you talking about? Roth IRA, 401k tax reduction. Like, what are you doing? I just trying to go to work and feed my kids. And now all of a sudden, like, wait, hold on a second. You can YOLO on GameStop and make money, right? And a lot of this also translates into a lot of crypto, which I'm seeing basically being part of the global financial thing. I mean, there's not going to be much of a distinction. As today we talk, well, do you use stocks or crypto? Well, stocks and crypto are going to be just, is this difference between Tesla and Apple. Like, they're both shares and you can go up and down, whatever. And in that, people are becoming more familiarized with, and they're more open to this idea. And some of these things like NFTs, for example, once you get going to crypto, it's like they're just taking pictures, something that, like, the most easy thing that they can understand without wanting to go down that rabbit hole. It's like, I invested in this thing and it went up or down and I made or lost money, whatever. Maybe I'll work my way over to stocks now, right? Because I got a feel for it. It wasn't that scary. So that kind of a gateway drug, if you want to use it, like it serves its purpose. Once people are in there, then they're okay. Because then they say, okay, I made money, I lost money, whatever it might be. And I don't think they're going to go away. And if the implication was 2000.com crash, a lot of people lost money, whatever. The time horizon for a lot of these individuals, given the crazy volatility that they're going for, is not long enough so that they can feel that they've lost money. Like, the time horizon is shorter, right? Meme stocks have a very short lifespan. And a lot of these trades, they're like get rich quick-ish, right? They're not necessarily let's wait for dividends. And I didn't see this New York Times articles about AMC, but I can guess what it might have been like as for a lot of GameStop people that are left holding the bag, and you bought at the top and now you're sitting on a loss. Like, I understand that. But I'd say that the majority of the people that are saying, hey, let's YOLO, let's join, let's have fun, let's share meme pictures, they're less worried about this this portfolio that they're looking, because they're most likely become tired of staring at this thing that's not paying off and they've sold it, or maybe they haven't and they're still sitting on it. But the approach is such different that they're like, maybe I'll do better next time, right? And that risk that's associated with that loss is very apparent. And people on Wall Street Bets and elsewhere wear that risk on their sleeves. And it's no surprise that there is such tenacity to come back, even when there is these, in crypto, you have these pump and dumps where the prices go up and down. In the 2018 or 17 thing with the ICO, and you're seeing it with NFTs also, and you're seeing, but they love it and they come back. They're like, I got greedy. I should have sold at the top. I'm going to do another pump and dump, but this time I'm going to be less greedy, right? Because I lost all my money with the last one. Like, they understand that name of the game and they're like cool with it, right? They're embracing the math, the sophisticated math behind risk profiles without realizing that they're there. They're just like, let's try and make us some money. People that want to have this longer term, whatever it might be, are going to buy dips. If you are buying and investing long term, whether it be individual stocks or different types of instruments or commodities, like, they're going to be patient through whatever .com bust, because we've now exceeded that price. or the 2008 financial crisis because we've now exceeded that price, or the 2020 crash because we've now exceeded that price. So historically speaking, if you have investors that are actually taking this seriously in the long term, then they're going to actually behave seriously and buy the dip and not freak out, because it will continue to go up and to the right, as it has for the entire history of the stock market. It's those more finicky ones that are being honest with themselves and saying, well, I'm going to speculate and high risk, and I may end up losing money, but then I'll try and better my approach so that I can try and lose less money, or I'm less likely to lose that money. And that's part of the game. It's like putting more money in the slot machine and just pulling the thing again. You don't get mad at the machine because you didn't win. You just take another coin out of your pocket and you pull the thing again.
Well, and I think one of the most important things in investing is the whole know thyself, know what works for you. And so and maybe that's WallStreetBets is certainly a transparent community as far as that risk tolerance. And so if it works and keeps them in the game, that's almost more important than anything else, really. So it makes sense. So, okay, Jamie, this has been fantastic. You've been super generous with your time. Thank you for speaking with me. Again, for anybody watching this, we'll put links in the article we published this in, as well as in the YouTube notes for the XTB event. Jamie's presenting. It's on March 19th, I believe, is the date. So watch out for that. It's only available to certain markets, but we'll clarify in the links. And Jamie, thank you again for your time, and best of luck navigating what's a very interesting market out there.
Thank you very much. This was great, Daniel.